Hello and welcome to the Gold Goats and Guns podcast for October 1st, 2024. This will be the second one of the day that I record, which I think is a new record for me. This is episode 195. So I'll be speaking again this year at the Expat Money Show put on by Mikkel Thorup, who I had the great pleasure of meeting when I was up in Edmonton earlier this year for Sean Newman's Cornerstone Forum. The event that he's putting on will be from October 7th through the 11th. It's one of the biggest expat convocations in the world. Now, this is a free event, and personally, I'll be speaking there twice, once by myself and once as a part of a panel with Alex Craner and Bob Murphy. So there will be people there like Ron Paul, Doug Casey, Scott Horton, Tom Woods is going to be there. So is Mark Faber. This should be an excellent show, and it should help you learn everything you need to know about crafting a potential plan B, and that's if you need one. Or if you're just looking for a way to preserve some of your liberty and or your wealth at a time as uncertain as this period in history, well, then this could be the show for you as well. This includes things like getting a second passport or preserving your offshore finances. It could just be that you want to invest in some international real estate. The folks that are there will be able to help you with all of that. So if you want to sign up and reserve your complimentary ticket, head over to expatmoneysummit.com and you can sign up there. We have a promo code and the link will be in the show notes for this podcast. I have with me, again, having Mac on the show now, I think for the third time. My good friend Chris Sullivan is from Hyperion Decimus is here, and we're going to chat about a number of things. Just to remind everybody, this will probably be the last podcast I publish before the Mises event next weekend. We'll be there in Hilton Head, South Carolina, which didn't wash away in the storm for once. And we'll be giving my keynote talk at that, and that's going to be very interesting. So with that said, Chris, how are you, and how have you been, and what's going on, my friend?
I'm pretty freaking spectacular, my friend. Thank you for having me.
Well, we're still without power, but I think I got my generator laid out in such a way that the carbon monoxide monitor won't go off. The propane tank is full. I should have an hour clear, and we should be able to talk without too much interference. It was funny. I just got done with recording episode number 194 with Chase's U-Cart, and we had to cut it off early because I'm like, I'm on backup power and I don't know if the UPS is going to last, and the Starlink could go bye-bye, and oh my God, we'll just do this again another day, love.
It's something only Southerners and or Floridians get the pleasure of experiencing. I too lost grid power, but I'm ultra prepped, so my solar system kicked on, and I have three-day batteries. Right. About a 30-second transition that was automated. Right. But we thankfully had minimal damage in Winter Park. But I think we're used to this in Florida. It's harder to witness to those who aren't, right? Like as DeSantis kind of already showed the world, we've got excess reserves to give to our brothers and sisters in North Carolina. We're good here. We know how to take care of ourselves. We're prepared. And, with destruction comes rebirth. So, the good news is the waves were really good. And,
It's funny. I was just in Winter Park over the weekend for the Beat concert, and I didn't realize you were there. I would have pinged you and said, "Hey, man, why don't you come over for lunch?" Because we wound up having lunch right in Winter Park the day after, Saturday afternoon. The concert was great. I could go on for 45 minutes about how Tony Levin is a god, but I don't think anybody would want to hear that one today. So we got a near miss. It was an honest to God near miss. I think what happened was the eye wall started to make landfall and then deformed, and the whole storm and the eye wall of the storm shifted right towards my house, right at the last moment. And I'll be honest with you, we got the back side of it. And, I was talking to somebody yesterday in town when I went in to get propane and whatnot. And they said, Fort White is leveled, and Fort White is literally the next town to the northwest of me. Yeah. So we were not prepared for that at all. We got about 85-mile-an-hour winds. We didn't have any damage. There's a tree limb down on an old chicken coop that I don't care about because there haven't been chickens in it for years. So it was something I wanted to tear down anyway. So now I have a newfound purpose for wanting to get rid of that particular eyesore in my backyard. All right. So with that said, and all of that out of the way, You asked me a very interesting question before we started, and I'm gonna just, I never know what we're gonna talk about whenever you're on the show. So, tell me what's going on, man.
I'm fortunate to be able to speak to a lot of different type of investors, both, institutional, which still you can't get past the human. And what's somewhat intriguing about institutional allocators, quote unquote, air quotes for those listening, is that in my 19-year adult career, those that hold the keys to the kingdom, so to speak, turn over every 3 to 4 years. So there's this sort of repurposing and repackaging of narrative, which I hate that word, but that I'm finding I need to do for my team, which we've been in solely digital assets for about 6 years, professionally, 10 personally. And as such, I get to speak to those folks oftentimes as they move through different entities. And then recently, which isn't our forte or background, a lot of families, family offices, etc. And they ask totally different questions, which I'm now way more dialed into. And then being a thinker, I arrive at this question organically, especially the last 6 months, on asking them, because most investors don't know how to think. Let's be honest. Most humans don't know how to think. And it just kind of resolves itself into one question: what is risk?
It's a good question. And when you dropped it on me earlier, my response was to cackle uproariously.
Right.
Risk is a very difficult thing. It's a different answer to different people, right? And at the end of the day, it's that thing that we all have to wrestle with in terms of, what do you think risk is, and then how do you define that versus the amount of reward you want to have, and what are your ultimate goals? It's funny. I tend to be a risk averse person, but I make very, very, what's the word I'm looking for? Spontaneous decisions, right? I tend to financially do, I don't have a portfolio. I just buy gold and Bitcoin and put it in the ground, and buy more dogs, right? I mean, that's pretty much what I do. And I've said this many times, because most of the, since I've been a professional at this, I don't like owning a portfolio of my own assets, because then I wind up talking that book, because I'm emotionally invested in those trades. Gold and Bitcoin are just hardcore long-term savings. You're going to buy gold and you're going to stick it in a box somewhere, because by the time when you buy it, you're already 15% down, because you're buying it over spot and then you're going to sell it back under spot. So you've lost 15%. It's like buying a car, right? So you're not making a kind of liquid trade. Gold is not a trade in that respect. Bitcoin it is to a lesser extent, but I treat it the same way as gold. So when it comes to that, but then on a day-to-day basis, I'll make very risky decisions with my life that I shouldn't. And so, it all depends on what hat you're wearing, and, what domain you're operating in, and what space you're in, what headspace you're operating in. That would be my short-term answer. My short
I think
answer.
that's a good starting point, right? Because it speaks to what I think the answer is, or what I argue I know the answer is. Yeah. So top down, it starts with risk being you, the individual, the investor, the human being. And each of those has their own sub risks, right? And having traded all markets, my favorite are obviously commodities. I love anything hard and real, and in that's why my whole team pivoted to crypto. You've heard that story before. Bitcoin is actually infinitely harder money than gold, in my opinion, and just scientifically. But when you look at markets, macro, micro, etc., that's not risk, right? Markets are only opportunity. And so even under classical definitions, the risk of permanent loss, that's what risk means. Well, no, you just said permanent loss is one of the risks. But what's the macro risk? And it's really people. And I've been getting better at separating, okay, if we understand we're risk, then how do we construct portfolios in a way that benefits from that awareness. Mm-hmm. And then from there, it just gets really easy. Because I've been fortunate to do this professionally and only screw up a couple times that were good learning experiences. Glad they were costly, and they were largely ego-driven trades that weren't data-driven or quant-driven. It was more like, oh, well, this is a setup, and valuation this, and then boom, you're wrong. Doesn't matter, and it refocuses you on discipline and processes at work. And the same thing can be true for your athletics, your health, your every aspect of your life. If you compartmentalize it, diversify it, and focus it, you're going to do well, whether through force or manifestation or both. And I'm just constantly shocked, absconded at the fact that a lot of folks are exposed to, at best case scenario, 50% currency derivatives. And they, because of, obviously, this better than most, mainstream media has been a oligarchy of propaganda. And then in the last 10, 15 years, through media outlets like yourselves, Newsmax, et cetera, you've been able to bifurcate some of that propaganda and narrative and give people actual wisdom. And seeking truth and wisdom, I think, is something we share in common. Obviously, you're at MISIS next week. Congratulations. I, too, am an Arsh, as you know. And I just think here we get really a credentialed people that can't think like people thought even 25 years ago. So, I think all investors should take a seat and listen to themselves. What am I concerned of? How can I get myself out of the way, or how do I know myself and benefit from anticipation of poor decision making?
Yeah, it really is interesting, right? I mean, how many times have I said, just to like to follow on that? I've said many times, people said, well, Tom, you obviously made a lot of money doing this. I mean, if you're your calls you're so right about all these calls, you've probably made. I'm like, dude, I don't trade. Like, I don't trade at all, because the guy you see sitting here talking about these things, or even creating the setups. I mean, we do this in the market reports twice a week, right? I'll go through and I'll do a chart read for somebody on a random stock, and and say, here are your points, and yada yada yada, and we look at the portfolio, and I'm not busting my hand, patting myself on the back, but the newsletter portfolio is doing pretty well, even with an 18-month bear market correction in commodities. Over the course of the life of the newsletter, we've done. I think we've done exemplary, right? But I don't trade those markets. I don't own those stocks. I know that I'm a different person when I own a stock versus when it's bad enough just recommending a stock to the public, or in this case, to the paid membership. It's a fundamentally different thing when I own the thing. Like, when I have my personal skin in the game, now I'm a different person. Now all of the things about my particular personality and come out badly, and then and interact with that position very badly. And so part of the reason why I do think that's why the way things are structured the way they are is exactly that. And then I'll be honest with you, Chris, this is something else I've noticed over the more I've thought about this, which is that not having that kind of thing to fall back on, always kind of living right on the edge, keeps you focused and in the moment, and makes you aware of the risks that are around you all the time. If you're comfortable, again, I've said this before, like, I lost a lot of Bitcoin early in the thing. Had I not lost that Bitcoin, would I still be the same guy, or would I be banging the Cabana girl in my private island because I had that many freaking Bitcoin? No, obviously it would be a different person. So, and that's the thing. So when we're thinking about this stuff, we really should think in terms of trying to know yourself well enough to know what you're good at and what you're not good at, and then leave those things,
it then allows you to
not mix them. Right.
You then can go appraise everything. You know the stats of the S&P, for example. Like, I think it's 81, 82, 83% stocks, right? Just disappear, right? And the only buy and hold thesis that actually works is the index itself, which the constituents are discretionary membership via committee selection, right? I mean,
right.
So, and then this too. It's negative against gold, negative in inflation terms. Inflation adjusted since 1999. It might be positive like 1% at 5,700 now, give or take. But okay, so what do we do with that awareness and/or wisdom? Well, I can't just say I like what is this shirt? Peter Millar, right?
Right.
Well, this is freaking awesome, and assume that I can buy this stock and reinvest dividends over a 30-year period. Nope. That's not a strategy thesis that you have historical evidence of working. Right. And so just those little tidbits on commodities, right? What's the problem with investing in commodities? Well, the fucking futures markets are the problems with investing in commodities, right?
Of course.
Explain how gold's at an all-time high, Tom, but silver is nary 60% of its previous all-time high. It's 2 all-time highs, right? Which is north of 50. How is that possible? Well,
I actually have an answer for that.
You do. I know. That's why I'm teeing you up.
I know. I have an answer for that. I hate for you to use this. There are better examples than this. Like corn is a better example. Tracy brought this up in the episode we just recorded. Like corn's trading at $4 a bushel. Corn was trading at $4 a bushel in 2013. Like, what is that in inflation adjusted terms? Like $1.50,
right?
Like, you know what I mean? So had are you buying corn futures and then expecting to get rich? No, you have to ride. You can only ride the pump and dumps in commodities like that. Silver, on the other hand, because it's losing its monetary character and becoming an industrial metal, now trades like trades like a commodity, and it trades more like corn, honestly, than it will ever trade like gold. And that's the hard part that people have to
de-link. Right, demand from what is it, 1980? What was the first 50 high? 84.
The 50, yeah, it was like 80. Well, no, the 2099, right? When gold hit 80, I think silver did hit. Did it hit that high? Because I mean, I remember $50 an ounce. $50 an ounce was the weekend that Osama bin Laden got offed in 2011, and that was the end of the silver bull market. Industrial
demand up over 1,000%, and then if we ever get the capital for data centers, add another 1,000% to it, because silver is an industrial metal. So that doesn't make any logical sense. It's a good example. Corn's another good one. Copper, same thing. How the hell is the purchasing power of fiat continue to decline, yet these commodity prices aren't really trending as the hedges that they naturally should be, because there's finite supply, right? There's cost of input to take copper out of the ground, to take silver out of the ground. Corn has a lot more risk than silver does from a production standpoint, right?
It's crazy.
So, I think that's part of this, financial engineering from the powers that be to keep investors away from commodities, to hide the sort of hyperinflation of currency supply that's not fully reflected in commodity prices. Nonetheless, it's just, again, more arrows to the quiver to understanding, okay, then knowing that, and I want to have a 10% allocation of commodities, what am I then doing as a portfolio allocation, which is not a trade, it's a permanent allocation within your liquid, or whatever you want to call it. I would say liquid tradable assets, investable assets. Are we going to approach investing in commodities? Because we can't argue for no commodities, right? No, that's negligent. And the same is true in my sphere of digital assets. At this point, Bitcoin's one of the most liquid things on earth, and it's also highly volatile, making it a very good trading instrument, and it's the scarcest, hardest thing ever, making it a very good investable asset. So either way, it ought to command n number of percent of someone's portfolio. But what I'm finding in just these simple, essentially restatements of fact, right, that very well, and 99% of people don't know that the paper silver market's like 42 times that of the spot market, right? Oh, well, is that how we suppress price? Sure.
Sure.
And understand mechanically how to approach something, right? Oh, why'd the stock market go down today? Why isn't the right question? Positioning and mechanics is the only question. Humans right now, they're searching for narrative. Do you think traders at trade desks just hit the fucking sell button because missiles go off? If anything, you hit the buy button, right?
Right.
No,
I agreed. Markets don't trade on fundamentals. They never have. They never will. In the long run, they might. But only it all depends on the you always have to, as I always say, you match the time frame that you're looking at in terms of the chart itself. You match the time frame to the time horizon of your thinking. So if you're thinking in terms of a portfolio buy and hold of commodities, well then, or gold or silver or anything else, well then you need to be looking at like quarterly and annual charts and nothing else, and only checking in with these things once a year. Mm-hmm. You use your quarterly charts and your momentum charts, and your annual charts are we in a bull market or a bear market chart? If you're a day trader, you're looking at hourly charts and are your momentum charts, and day charts are your get out of the trade charts.
Right. And unless you're a professional hedge fund manager, you shouldn't freaking day trade. That's literally the people that thinking they should manage their own money. And please, this is not me toot my own horn. We're specialists. We do a special role within a portfolio. But even, do you think I manage my own commodity exposure? Absolutely not. We go through professional CTAs. Do you think I manage my own real estate portfolio? Absolutely not. We go to Blackstone, Hines, Eaglebrook, Brookfield. Like I don't know how to do that stuff. And then nor am I going to try. And it's the same thing. Hey, Tom, I pulled my ACL apart. I'm going to do my own knee surgery. Really?
Yeah. Sounds like a great idea.
And then
I watched a YouTube video and stayed at a Holiday Inn Express last night.
I read the Cliff's Notes. And so, wait a minute. I think I can go up in the most competitive market with the smartest people on earth and compete. You got to be kidding me. That's like, I'm going to go swim the English Channel at 43 years old. I probably could do it, but that's how egregious the effrontery of ego is for humans thinking that they can trade their own money and then assign, n number percent to some quote unquote wealth manager that maybe knows less than they do. It's just all what I would call fiduciary negligence, in my opinion. Yeah. And it's your money. It's on you to educate yourself, right? Mm-hmm. Obviously read everything Rothbard, Hayek, Mises wrote. That's a hell of a starting point, right? And you're going to know monetary history better than 99% of your peers. And then why do hedge funds exist, Tom? Oh, because rich people want specialists to run their money. And guess what happens if we lose? You get a freaking tax write-off.
Right.
Hyper tax. That's why hedge fund exists, because it's a hyper tax efficient way to take risk with capital. Mm-hmm.
Right.
So, I know we're belaboring the risk point, but I think it just harkens back to like really understanding how to construct a portfolio, right? There's four quadrants, right? Asset protection, accumulation, and then trading risk speculation, right? Mm-hmm. And then accumulation, right? So there's only four things you can even do.
Right.
And then under asset protection, I don't really know if insurance contracts can be part of that anymore. You're a Floridian, 34 cents.
Yeah, no, you can't.
So that needs to be, Bitcoin Gold serve three of those, right? Accumulation, speculation, asset protection.
Right. Yeah, no, it does. They do. Yeah. And it's what makes it. I agree with you on that point. And you can never belabor the point too much that people take on excessive risk. Like, we live in a world where we're not pricing risk properly at all. I mean, that's the most important thing. That's the most important lesson that you take away from even just a first kind of like a first year of high school Austrian economics perspective, which is, even if you don't agree with all the praxeology and it doesn't matter. You don't have to like drink all the Kool-Aid. All you have to do is realize, these people all the interventions into the markets are designed to purposefully misprice risk that someone else can use that arbitrage of that mispriced risk to steal your fucking money. Once you understand that basic thing, I don't know why once I understand, I'm like, that's why I really like gold. I get it now. Well, you can't steal it from me. I can't sell it, but they can't steal it from me either.
But if you're day trading gold, right? In those four quadrants, again, like cash flow, accumulation, speculation, and then asset protection, hedging, right? You trade gold for cash flow if you're good, but more likely if you're trying to do it in that quadrant, you're going to get your ass handed to you, right?
Oh, yeah.
And then if you're doing it for asset protection and you're looking at your quarterly and yearly charts, you just set my rule, buy when oversold.
Right.
Okay. And I'm just adding to it. And then that fills asset protection accumulation. So it's so easy to take something you enjoy, something you know you need, and compartmentalize it into a simple process to execute a two-pronged if this then that statement to get yourself out of the way. And oh, by the way, there is a rate of change and decay of your fiat. That's really the macro prudential risk that you're fighting against, which is why you're forced to invest to begin with. And just the balancing that, and you're going to be fine. There really is a scarcity of assets, Tom.
Like, I know, Chris. I'm going to say the same thing. It's like I've also thought about this. I'm like, we're blessed, or however you want to put it, with now, Gold, Goats, and Guns is successful enough, for example, that, there's enough income coming in that there's investable assets on the table, right? And this is a new thing for me, and I'm like really very used to it.
The truth.
And then you sit there and you go, okay, well, now you live in a communist, corporatist, whatever environment. You live in a confiscatory environment. The more money you make, the more money they take from you on a percentage basis. Yes, so you want to protect that. So they're telling you, hey, why don't you go into this? Why don't you go into this thing over here, be it a Roth or a traditional IRA or whatever, in order to, like, you get, for example, you get 28% back on your money just by putting $5,000 into this thing, because the government's not taking 28% of it. But now we're staring at the Iran and Israel are lobbing missiles at each other. The British are trying to get the United States involved in Ukraine. They all know that the whole financial systems are going to collapse. I did a podcast with Alex Craner that should scare the bejesus out of everybody that the Bank of England is about to go bankrupt, right? We're staring here at the end of LIBOR, this, that. Here are all your risks, and you want me to lock my money away in a fucking tax deferred account for 28%? Fuck you. I'm buying gold and I'm burying it in the ground and I'm getting another damn dog. Like, that's the only rational conclusion I can make, and I don't care about my cash flow. Like, if I want, in my position, I'm in a position today. I'm just giving everybody, like, this is what goes through my head on a daily basis. Just, Chris is putting out the ideas. I'm giving you what that looks right in real terms, and it looks like me going, yeah, no, I'm not giving you that money to you 2 and 20 carried interest guy to like fuck around with. And, oh, I'm sorry, we lost it. Like, fuck you. No, I'm not doing that. I'm going to do what I can. And yes, Mr. Government, you can have your 28%. I hate to say it, but you can have it. It's easier that way because I know in the long run, I'm actually taking on no risk, because that 72% that's left is mine.
Now,
and that's it.
To plead our case, we do a lot for our 2 and 20, Tom. So no offense taken. But again, Chris, I'm in a very difficult position from my perspective. But no, you're absolutely correct in that there are people in the industry that if you're thinking like if we're sitting here doing this, and I know this is an audio podcast. As I was going on that rant, Chris is sitting there nodding his head and because you're
smiling and everything else. So I'm right, but at the same time, I know that he's going to be one of those guys that actually gets that and still wants to manage people's money. Now we've de-risked that rant that I just went on. Like, the fact that we can sit here and have that conversation when you're on that end of the conversation, one end of the conversation. I'm on the other side, and we're agreeing. Now that's a different scenario in terms of risk.
I'm grateful and humbled to agree with you, Tom. But this is going to sound terrible. I'm not a typical person in my seat. I wouldn't be.
I know that. That's why you would. That's why you're on the podcast, Chris. Because if you were a typical guy, you wouldn't be here. Like,
right.
Like,
much obliged, my southern friend. But we're 24/7 shop. Everybody deserves to get paid for the service they provide. If we don't provide a service, fire us. Right? Like, we're hyper anarcho-capitalists in that regard. However, because I'm not shilling, right? Literally, our funds. We just partnered with CoinDesk on a long short fund we launched in March. Like, the camaraderie and collaboration in digital assets is something to behold. And so we're super proud of that. Would have never done it without them. And this is just vehicles to bring people into what our money backs. Not, literally we're still one of our biggest LPs with, eight figures of our own money in these funds. So it's a little bit different seat that we're able to be in because Goldman Sachs doesn't own me.
Right.
The Bank of England doesn't know, we're self-financed and don't answer anybody but our clients. So we really do advocate, hey, whatever wisdom you think we have, use it. Like why I was nodding and smiling. Well, don't you think I have safes of gold under my pool? Yeah, of course I do. Because what's the strategy there, Chris? Well, the strategy is I get to remove assets from bank which don't exist. And here we'll do a quick side take. Why don't they exist in the bank, Tom?
Well, because all the dollars are digital. Like they're not real.
UCC Article 8 and 9.
Right.
You know the great taking's coming. So I don't know if you're.
I'm not a huge fan of that. I see. This is, I think, where we'll part company on a lot of this stuff. I think the idea that that in the United States they're going to take all our money. Yeah, let them try that. They're going to do that shit in England. They're going to do that shit in Europe. I don't think they're going to do it here in the United States. That's another thing. Because,
sure. But then why did they put in the legal mechanism to do that?
Who put the legal mechanism in to do that?
The dematerialization started in the 60s. You know this history.
I know.
And the who is the same who, they, blah, 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 that it always is, right? The head of the snake, no matter who you think, Illuminati, cabal, Council of Foreign Relations, APAC, central banks, it doesn't freaking matter. The central banks are the head of the snake, right? Military industrial complex, pharmaceutical industrial complex, they sit many levels below the head of the snake. And, through politician financing, some people call that, consulting. Some people call that profiteering. It's really just
where I'll push back on this. And it's simply because you cannot you can threaten that, but you can't kill the golden goose. There is a fundamentally different philosophy at the top of our financial system than there is at the top of the old European financial system. It's a fundamentally different world. And they have gone full retard commie. We haven't. Because they know. I'm
when you say that, but then I look and we have a full retard commie who's not even been voted for running for presidency.
Yes, I understand that. I'm not talking about the political. I'm not talking about the political class here. I'm talking about the people who actually own the Federal Reserve.
They own the Bank of England too, Tom. You know that.
Yeah, they don't own the same. No, they don't own the same. They're not the same people. Not anymore. They're not in the same club because the people who want to own the bank, the people that, and in some ways, if you're looking in the last couple of days, what you're really seeing is has the Bank of England decided to pull the plug on the British Parliament, because Keir Starmer is in serious trouble and may wind up getting nuts and sluts out of office really freaking quickly.
He's arresting his own people.
But this is now Davos versus the British remnant. Those are two different factions, right?
There's many factions, and they don't all answer to one. And I'm agreeing with you. Powell's not a globalist Davos boy. I don't. Right. I've always agreed.
But at the same time, he's nobody. But at the same time, he's nobody's hero either. Like, don't ever, I'll never make that argument. But what I'm saying here is that the thing about the great taking that as a thing that still bothers me, and maybe it's my coping mechanism. I'll cop to that. But it just seems to me that, like, hey, if Diamond at Gold, if JP Morgan and Goldman and Morgan Stanley and all the rest of them, like, they don't care. They don't need to take what's left of the rest of our money. They still want to milk us for rebuilding the bridges and the roads in the United States. They don't care. They were on board with the whole globalism thing when it was to their advantage. Now it's turned predatory on them, and they're going to pull back from that. That's what I mean by I don't think they'll pull it off here in the United States. I think there are a lot of people in the political class that want to do this in the United States. I absolutely think that Kamala Harris, if she wins, will attempt to do this along with the rest of the infrastructure, but she's going to have to fight the Federal Reserve and she's going to have to fight Wall Street for that. And, unless Jamie Dimon winds up dead on the side of the road, I say good luck with that, Kamala.
I'm with you. Wall Street has realized that, wait a minute, you're not going to CBDC us out of existence. We'll play along with your usury soul theft as long as we benefit, but we're not letting you destroy everything.
Right. We're not going to let you destroy us as well.
But at the same time, Tom, the legal framework for this confiscation of property rights of securities and cash, which has already occurred. We do not have property rights to our securities and cash. That happened in the United States first, 4 years after that, Europe, and 6 years after that, Japan. So I ask my good friend, why would we, as the United States, put that legal structure in first if we had zero intention to utilize it?
It's a good question, and I'll leave it there. I don't have a good answer for it at this point in time, other than the fact that I can say that back then, that was part of the plan. Fair. And I don't know that the plan that was put in place back then, that the plan that existed back then is the plan that is being executed today.
Well, it's clear they're flying by the seat of their pants because they are losing, I think, the metaphysical and consciousness war against the apex people across societies across the planet. I think they already have lost that battle, and you can tell it's sloppy, it's incompetent, they're overreacting, and they're reacting too quickly and swiftly, and making a lot of mistakes. I needed no more proof than that than watching Tim Walz at the Minnesota-Michigan game get booed out of, at 960 hertz. I go, so that was the highest consciousness boo I've ever heard.
Right. No, that's a good point. I think that, and again, when I look at what it's one thing when everybody's winning. This is the point I make all the time, that when everybody's winning, everybody in the room is fat and happy. But the minute you reach that, and this is where the whole Misesian, Rothbardian critique of the systems comes back into play, which is that we have always known that at some point we were going to reach that moment where the cartel was going to start beating on each other because there was as you put it excellently earlier, that there's a lack of actual physical assets. And now they're scrambling for the physical assets. It's always about collateral, and they can't secure the sources of collateral that in the same ways that they always have in the past. So you put, if I'm them, I'll put on my evil hat for a minute. I'll put on my Sheev Palpatine robes and we'll do the thing. And I'll say, look, let's have a fallback plan. The plan is, of course, that we're going to destroy Russia, and we're going to split up the Middle East, and we're going to take all their oil and their gas and everything else. We're going to do all this stuff. But if we fail, we're going to need a fallback position, which is that then we're going to need to take all the assets of the people and protect ourselves that way. They're hedging their risk as well. Like they're not dumb.
Well, things can happen. Like for Bitcoin, like
right.
What?
That's a good point. That's a great point.
Bitcoin will end up being the new central bank. Like literally, if you want to know that they fucked up and can't go on any further, 4.7 quadrillion in credit derivatives is what's spinning around, and then a baby 2 trillion wipeout of the yen carry blows up the stock market in 3 days. What happens? They prop it right back up as soon as the forced selling stops. This is illusion. No one's ever paying back the debt of any country. That's also a joke. You owe it to people who can counterfeit that money. So that's kind of insane. And then I'm sure you've seen
why would you even pay it back, knowing full well that they printed the debt out of whole cloth, and then and made you and in effect it's almost like a contract of adhesion.
Not almost. Think about it. You are.
Yeah.
I mean, Road to Serfdom, it was like they followed that and Orwell and Aldous Huxley, and Ayn Rand for this, we're gonna do the opposite. So I think putting all that into context as an investor is not easy to do, right?
Mm-mm.
We've been, you better than I, reading everything under the sun in this subject matter. But we still have to act, right? I may agree with the Harry Dents and the Doug Casey's and all those, doomsdayer guys from a valuation standpoint and go, look, overnight we're limit down. Well, guys, that's 5%, and they're going to profit anyways. Right. So I can't worry about a 90% wipeout and make an actual plan that we're going to affect today.
Right. No, you
just can't do
it. And more to the point, like how do we get there? Like when you know full well that okay, we didn't wipe out the yen carry trade, and that's all bullshit. Like we wiped out like 1% of the yen carry trade.
You mean the quant hedge funds that were American that were part of that trade is who we wiped out?
Yeah, or whatever. And there was one part of it, and was probably just the NVIDIA part of it. Like there's a whole variety of other. I mean, the yen carry trade was 35 years in the making. It was not unwound on a Monday.
No, I wasn't implying that. But
no, I know you weren't. I know you weren't. I actually was yelling at Bloomberg and CNBC. Oh, it's over now. The yen carry trade's been 70% unwound. No, it hasn't.
Maybe 1%.
Yeah, Jan. Okay. Yeah, Jan.
1%. Because the big boys don't have to unwind it, right? It's only those that actually levered to where they were getting blown out. Because all of these, whenever you're short volatility or you're negatively convex or short gamma, you're going to lose your shirt. It's just a matter of time. No one should structure trades as a policy to be short volatility or short gamma. That's just insanity and again, fiduciary malpractice.
Yes.
But nonetheless, certainly not. I mean, the whole fucking bank is the yen carry trade.
Right. I mean, that look, and then this was interesting about this, and I haven't had a chance to talk about this publicly yet.
Bring it.
Because it happened on, and this is Japan, right? I want to shift into Japan because Japan is really interesting here.
It is.
So Friday, before you and I spoke, so on Friday, the Liberal Democratic Party had their leadership election. Mm-hmm. And the Abe wing of the so as opposed to European politics, which I've gone into great lengths to try and explain the internecine squabbles and murkiness of it all, from Germany to Italy to Britain to the Netherlands and all the way around the Horn. Japan's really fucking easy. Ready? There's one party. There's two wings in that party. One of them is vaguely libertarian, and the other one is openly corporatist.
Mm-hmm.
The corporatists have been in charge for the last 30 years. The Shinzo Abe wing of the Liberal Democrats have been in charge since, the Nikkei blew up in the early 90s, blew up and popped and collapsed in the early 90s, and they went to QE. Great blog by Ira Harris's son Tobias called Understanding Japan on Substack that everybody should read. Mm-hmm. And I'll actually put the link in the show notes to a couple of the articles that he's written recently that really got me to understand this. So Ishiba, who was just elected and is going to consolidate power at the end of this month, has been fighting Abe for 25 years. He is going to back the BOJ normalization of monetary policy, whereas the old guard was going to fight Ueda tooth and nail. They thought they were going to be able to win, and the markets have all priced that the Abe wing of the Liberal Democrats were going to win the election and therefore still run Japan and still basically have Japan be a neoconservative foreign policy tip of the spear in the Pacific Rim. Meanwhile, the Bank of Japan has the personnel who are in charge have all shifted. They're all in Ishiba's camp. Okay. So the writing's been on the wall since Abe was assassinated that this was all going to end. That's why Kuroda did not. That's why Kuroda retired. That's why all of his lieutenants eschewed and deferred and didn't take up because they knew what was coming because they could read the room within the Liberal Democrats. They didn't have a majority. Ishiba was going to come to power, even though it's a shock result and everything else. But you could see it all within the Bank of Japan. So knowing that the yen carry trade, as we've known it for the last 35 years, is going to be systematically and steadily unwound by the Bank of Japan and the Ministry of Finance, because now you have political and monetary policy are not at odds with each other like we have here in the United States, where you've got Davosian, ultra Davosian, friggin' Janet Yellen undermining sovereigntist Jerome Powell. and Wall Street sovereigntist Jerome Powell. And that split, that we're still fighting that. And even
they're going to have to raise rates. Yeah,
what's that?
Powell might be forced again to lower in November.
Sure.
And I don't like being predictive on this too, hard. But I think because we're going to see a real bout of real inflation. I mean, shit, the dock closures, the port closures is 5.4 bill a day, according to Goldman. I mean, this is just terrifying that we have such incompetence amongst all human beings currently. But nonetheless, that unwind is going to require liquidity, like so much liquidity from ECB, from the Fed, just to hold things together, that we probably could see. I mean, I think I said this the first time I came on. We probably could see QE with rising rates simultaneously.
It's possible. I don't know. I'm going to say that what I would say is the Bank of Japan is going to be the source of global
the back
tightening.
End of the curve is going to skyrocket regardless of what we think.
What's that?
The back end of the curve is going to skyrocket regardless.
Oh yeah, no, I don't know. The bear steepener trade is coming. It's already here.
I got into it before it just went as a mechanic setup. Everybody's on one side pricing in 3-4 blah 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 cuts, and I'm looking at the commodity, index itself, going shit, that's about to rip. I'm looking at the dollar, that's about to rip. I'm like, well, I have fiat here on this Interactive Brokers account. I'm going to go do a giant bear steepener trade and hope I'm wrong, right?
No,
and then
was
wildly correct, and I'm going to hold that for a while. But anyways,
you should hold that, because right now, and you can see it intraday in the markets, Lagarde is sitting on the long end of the U.S. yield curve. The Bank of England is doing the same thing. Exactly what I said I expected to happen with 25 basis points is happening with 50, which is that the market wants to sell off into the bear steepener, and the BOE and the ECB are both buying into the selling to keep prices from falling. They are now trying to prop up an overvalued treasury market like you wouldn't believe. And it's beautiful to behold. And at some point, one of them, and I think it's going to be the BOE, is going to cry uncle and ask Uncle Jerome or Uncle Jay for help. He's going to give it to them with strings, but the strings are going to be get rid of fucking Starmer.
If they don't, there's going to be larger consequences. But I think this is the dialogue, not this dynamic, but I'm trying to show the color that we're having to investors, saying, look, you want to have all your eggs in this basket that's requiring injections from the BOJ, injections from the New York Fed desk, and then look at China. Oh, we ban short selling. We QE bazooka to financial firms and insurance firms, buy stock. You want to invest in a market that is at least as real as it can be, right? And going at this thinking this isn't a full manipulated video game is insane. It's all just a fucking illusion.
It is funny that we can actually now sit here and talk about sovereign bond markets being fake and gay.
Yeah,
and I find that really, really funny.
We need new pronouns, Tom.
Yeah, I mean, it's just crazy. But it's absolutely the case in Europe. But Lagarde told you she was going to do this, and then she's just done it. And then she got her friend, Janet Yellen, to help her out at Treasury. If Yellen is removed from the scene, and again, these people are going to do as much damage on the way out the door as they possibly can, because they have to, as vandals, they cannot accept the loss. So they're going to, I'll be honest with you. I think as bad as things are right now, what you're seeing in the geopolitical arena with the hotting up of, Iran, it was Israel crossing major red lines, with Ukraine crossing major red lines, both of them getting pushed out the door by the fucking British. Like, are you kidding me? Can you not see this? Like, to me, it's so freaking very obvious. And then to have Starmer and Lammy and Zelensky meet with Trump after the UN General Assembly and get nothing. And then that was on Thursday and Friday. And then on Monday, I'm seeing a nuts and sluts campaign against Keir Starmer that might get him thrown out of office by the end of the week. Are we kidding here? Like,
They play a masterful game. At that highest level. They play a masterful game. I mean, look, it's again back to try and like narrow this to like what we can do as investors in building our portfolios. You have to ask yourself, do I want to be 90% complicit, 50% complicit with all of this shit and having my labor converted to fiat, converted to equity, bond, whatever, that is literally requiring not just life support, like epinephrine, a kilo of blow, blocks of Adderall, gallons of coffee. It's not even on fumes.
Have a dozen cigars.
And it's not the market of our grandfathers. And unfortunately for you and I, the market's not been able to punish these inept politicians as it once did.
Yes.
Right.
Yes.
And look at this, like gold should be, what it is mathematically, what it's intrinsic. It's, 15, 20K easily, silver 300-400, but we're never going to get rid of the paper shorts unless there's no central banks. But notwithstanding that, oil, which also is heavily papered over, right? I mean, 110, 120 would be a war premium that I think we could agree as a valuation would make sense. It's 70.
So I would be okay with that. I mean, I'll just say that I think oil on the current supply and demand numbers is $90 a barrel.
Yeah, easily.
And then add another 30 to 40 for, supply disruptions, I mean, look, if Bandar Abbas gets turned into a parking lot tomorrow, which is very possible, then everybody who is net short oil will open at $300 a barrel. Bye. You're gone.
But then
you've been nuked. You're done.
I hate to say this. They're going to do what they did to nickel a couple of years ago in Q1. All my hedge fund buddies that were CTAs, long nickel, what happened to their accounts at LME? They got frozen and stolen from and repriced 30% lower so that JP Morgan didn't get blown out of existence. And they'll do that with oil. Shit, Tom, March 23rd, 2020, oil went negative.
Yes.
Now, hold on. So you're telling me a barrel of oil, I'm going to pay you to take it off my hands? Think about this, people. Like, I hope y'all listening understand that on the Chicago Merc, it went to, I think, negative 31 was actually, I know I was on the phone trying to buy 1 million barrels. I ended up just doing the future because I am a DMM, designated market maker, and I do have all the futures principle, yada yada yada, swap deal, all the contracty stuff and designations to do that. And I ended up just playing the financial futures to win on that. But conceptually, understand you don't live in a real financial market when the price of something that takes up half the room, that powers everything, is a negative number. That, and I'm not that old. That was 4 years ago. So I was 38. That was shocking to bear witness to, Tom. Not just the propping up of the stock market when I was on the floor of Morgan Stanley in 2009, witnessing that. That was all fake. And then they told you, hey, we fired off $6 trillion into bond ETFs and stock ETFs, the Federal Reserve, right? Also March 2020. And people, I think, again, backseat, what amount of your capital you want to have in that system? And start there.
I have defaulted to less than 5%.
That's
me personally. And and I've been in that, but I've been there since 2008.
I'm 7 or 8%, Tom, personally.
I think not only 5% in the last couple of years. While I'm like holding I'm holding some very simple dollar positions just to make sure that I have enough liquidity to pay my taxes next year. I mean, we're not even talking about like a lot of money here. So that very honestly, just so that listeners know I'm not full of it, that 7-8% of my net worth that's in that system is literally just to trade. I don't consider what I have on Schwab or Interactive Brokers or Morgan Stanley, whatever, to be investable money. It's trading capital. So in your 4 quadrants, cash flow, asset protection, accumulation, yada, yada, that's speculation and trading. That's the allocation there. It's not in cash flow. It's not in asset protection. It's just trading and speculation. And that's mainly because my skill set, I can manufacture money, or what they call money. Right. That's my skill set. I don't care. Show me a ticker, give me a startup capital and sit me down. I can do that. I can't perform neurosurgery.
So that's the only reason it exists, is because these things are liquidity vehicles. And those liquidity vehicles, as papered over as they are, they're still scarce relative to the monetary supply explosion that's happened over the last 20 years, and just absolutely megaton nuke of it the last 4 or 5 years.
Yep. And it's funny, and I watched this play itself out, Chris, and what's really funny is, it's clear that to me, it's I think it's been really clear, and I think the thing that really rocked my world was when I finally realized that no, COVID was an operation to force the Fed back to the zero bound.
No, I would argue it's not its primary agenda. It was one of the agendas.
Oh, it's one of the major agendas, because the only way you were going to get Powell off of raising interest rates was for the bond market to go bidless.
Fair, and it's definitely part of it. But
I mean, because they said, and goes right back to what you just talked about with oil. Remember, we have an OPEC Plus meeting on a Friday, which says, "Hey, we're not going to cut production." On Monday, oil opens up 50% lower. Now, is that fucking normal? We just have Iran and Israel lobbing freaking missiles at each other, killing major, and oil opens up this morning down 90 cents. And then it's up $2 when are we all stoned? Like, do we not remember? Like, no, you all just pulled your fucking bids. Like, you're just a bunch of vandals that played a game.
Yes.
And you use COVID. And then you rolled out the COVID the COVID thing, like literally 2 days later. It's all happened in a 5-day sequence in March of 2020.
Not only are you right, you're like more right than anybody wants to give you credit for. And you know this because we are market makers. Order books are, I think I've said this before with you. Order books are living, breathing organisms, right? The way we have an entire algo strategy just on order book alpha, Tom. It doesn't give an F what the price is, what the momentum is, what the blah, blah, blah. It's pure order book factors.
Right. And that makes perfect sense.
It's you have to be an investor to get access to it, but it's a beautiful, beautiful strategy.
Of course. No, you don't need to get the keys to the candy store away first. You have a business.
But my point is that why would I derive a multi-factor linear regression based model solely off the order book if it didn't do exactly what you just said? Well, I know I'm, Florida redneck, whatever. I might be highly educated, but I argue highly propagandized because I taught myself how to code after college,
Right.
So
you used to be a journalist is what you're saying.
Forensic. Yeah. I would try. Yeah.
So I'm saying journalists learn to code. Journalists learn to code. It's an old joke. Never mind.
I'm not that old yet, Tom, but forgive the past on that. So, anywho,
my point was, I hated it. I'm sorry. I broke your train of thought with a bad joke. I apologize. That's bad host, no biscuit. The point being is that the order book is everything. And, when we understand that what we think of as capital markets are all based on the order book, we look at the bids, we look at the asks. And if everybody who's on the bid just takes their bids and removes them, all of a sudden there's no market. And the market and the next person to trade and sell and if you don't think that there's somebody willing to, oh, by the way, we're going to lift all our orders off the book, all our bids off the book, and you're going to buy that contract at $40 and make a market in it, and they're not the same fucking people, then hey, I have bridgefront property in Brooklyn. I really need to sell you.
But Tom, there's rule reg NMS and NBBO. I thought, what? And this is again one of those things of uncovering.
I'll remind you of the day that I was watching Chris Whalen during the on CNBC during the financial crisis, and somebody brought up the Chinese wall, and he literally just like spit his coffee across the room, and he said, "Oh my God, will you shut the?" I could see Whalen. He almost wanted to say, "Will you shut the fuck up?" Like seriously. Okay, it was just funny. Go ahead.
And him who's the guy from Chicago? Oh, Rick. He was fun back then too, screaming.
Oh, Santelli, yeah.
He's kind of always fun. I really like that guy. He's fun. At least
he's a good guy.
Tells the most amount of truth out of one of those talking heads that I've seen. And I can imagine his role's been extraordinarily frustrating for him. So I give him a pass on anything that they've told him to say. But of course. So back to order books, right? We frame them 3 ways from Sunday. Heat maps. Literally, the most neat thing about it's cancel replace, right? So cancel replace higher, cancel replace lower, right? And then because the amount of humans that have enough or entities that have enough capital market make is less than a few dozen on the whole freaking planet, that you get anointed and you get to turn off your GameStop trading at Robinhood when you're one of those market makers, right? But you can pull all your bids on oil and say, hey, it goes negative, folks. Screw you. And that all the people getting stopped out on their longs force that going negative. And it's, again, a confiscatory practice of transfer of wealth. And it's through mechanical structure of these markets and trading systems that people need to become aware of. And not go, oh, well, the stock market always goes up. No, you idiots. That's not the case. No. You're looking at a number. They've conditioned you like a dog to watch that is an irrelevant number.
Yes. Yeah, no, this is a really valuable conversation. So I just wanted to just like make this abundantly clear and because and it's a point that I try to make all the time is like, look, every day they have to write headlines to sell eyeballs, right, on what's going on. And it's a narrative generation machine in order to create quote unquote a simulation of a world and a real market and real this and real that. And they know the trading algorithms are out there reading the headlines and reacting to the headlines. So this is why you'll see the AP on Monday say something bearish about oil, and then 2 days later change 2 words in the headline and be bullish on oil, and oil moves $4 in the process because they're vol washing a bunch of because this is how they manipulate the market, knowing full well that they know they can get a massive amount of movement as everybody reads the same algorithm the same way. So you have markets getting functionally dumber, quote unquote. The more we have an AI in trading far longer than everybody else. We've watched the AI algorithms destroy capital markets this way, and now they think that we're going to just turn it all over to AI is going to change everything. No, it's just going to get even more sophisticated and more gigo. It's going to be even more of what we've seen to the point of it being irrelevant.
Realistically, to speak on what is called AI, because it's not AI. LLMs are not artificial intelligence, ladies and gentlemen.
No, they're not.
There's nothing sentient that I'm aware of. There's 2 quant groups. I won't name either. There's a chip made of sapphire. That's a hint for those who know what I'm talking about. The chip is $14 million. It is not for sale on the public or private markets yet, but nonetheless, there is tech that is insane. It's not the vaporware dumb shit stocks you guys are buying, because it's just a dump. It's just a dump of narrative to get out of shares. Look at all the insiders selling into this so-called AI rally. All of what you just pointed out, Tom, these algos started in 97 that trade markets, and the big boys trade dark pools and trade secondary markets. Because even me, and I'm a small fish in a big pond, when I need to do a big derivative trade, I trade in the secondary market, not on the CME, and we negotiate price.
Right.
And you do it with a regulated swaps dealer through a mutual entity, Cayman, Swiss, whatever. That's how that actually occurs, ladies and gentlemen. I don't, with anywho, it was maybe more.
That's funny. What we need to know is that like the real players are not on the exchanges. They're this is why I don't trade. I don't trade because like hard enough just running the shop that I run. How am I going to spend my time staring at a ticker? And it's not even worth my time. I can go out and write an article and make more money.
Here, I'll tell you the truth, ladies and gentlemen, even deeper. Today on the CME, I mean, they may come after me. I don't care. The bid asks between options on Bitcoin were 40 to 50% wide.
Are you kidding me?
No, I went back and forth with another much larger publicly traded market maker, and we're wanting to do a two-way, and I'm like, I'm the bid and the ask on these two strikes on CME. Me.
Mm-hmm.
Now, is that even close to a remotely real market when that's the case? No. There's no competitive bid ask, especially when on both sides, right?
Right. Not when you're on both sides of the trade. No.
And it was so wide. I even said back to them, yeah, I see spreads are super wide. I get why what you're quoting me is dog shit. I'll wait. And then, we paused, and then we came to our own arrangement 20, 30 minutes later, because we know I'm good for my collateral. They're good for their collateral. And we're happy to make a trade together that benefits everybody. And that's a real market, right, ladies and gentlemen. And all of this uncovering of opacity is just to arm people with knowledge. What happens when you're armed with knowledge? You're then defanged from fear. And then when you're defanged from fear, you can think clearly about what you want to do. The whole role that anybody like me really has is peace of mind, Tom.
Mm-hmm. No, it's the same thing. It's the same thing what we're doing here. Like the same. I remember Camille, my wife, turning to me when I was watching this like blow up, and she's like, I'm like, I don't understand why this is happening, because we sit here and talking about like these esoteric things, and you're making sense of things for people, and that helps them be able to get through their day, focus on the things that they need to get focused on, and they can shorten the amount of time that they have to spend interfacing with the crap that you spend all your day trying to figure out what's going on. So you take 8 hours and then turn it into 10 minutes for somebody, and boom, like that's a massive time advantage for them. And that's why this works.
And I haven't been to articulate it, especially as good as I can with you, because you're a compatriot, but this is 20 years of knowledge and wisdom. You can't read this shit in book. You have to actually do it.
Right.
And just because we can code, and my partner's MIT and blah, 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 that doesn't make you good. Like, an algorithm is only as good as its logic. That's why when you type in, hey, Grok or ChatGPT, give me a 3 sharp mean reversion strategy. It can't.
Right. I can give you a witty meme of a picture of Kamala Harris.
Well, but Starmer will arrest you for doing that, Tom.
Fuck Keir Starmer. He can come to my house. Like, there's a reason why it's called Gold, Goats, and Guns, right? And so Keir Starmer can come to my house. Wait, I'm waiting for him. Please.
Does the second protect the first? Is that why they wrote that in there? Oh, Mr. Kerry, you're not going to get to remove that, buddy. I'm sorry. Go to the next World Economic Forum, you pedo cuck.
Seriously. Like, again, it's the same thing. Like, yes, the Second Amendment is what guarantees the First Amendment. It's far more important.
And people are getting too doomsday, dude. Yeah. Can the markets correct 50%? Cool. Well, guess what? What do we do then, Tom? You look the other way and you buy. It's too late to plan it. People just assign so much emotional, like, daily. What am I looking for? They assign their happiness emotionally to what the illusion on a Web 2 screen tells them.
Yes.
You morons, you're losing 11.2% of your time a year, no matter what. And what a privilege we are in modern society, where you can actually offset some of that.
Mm-hmm.
And why not approach it from, go to esoteric a little bit, from a position of gratitude and humility, and watch how much better you're going to do.
Mm-hmm.
And so with Bitcoin, for example, and gold, I can't buy here yet, but the moment it gets oversold on a 1 day or 12-hour chart, I am going to, right?
Right. Mm-hmm.
Does that mean, the NAV that I lost from 26.42 down to 23.12, which is where I will buy, do I give a shit? No, because I'm not going to monetize and pay the government that arbitrage on my long-term capital gains or short-term capital gains, because then I got to offset 37.7% just to break even.
Yeah, exactly.
So there, that was a process to give human beings, all right, you want to accumulate gold over time. There you go.
This is how you do it.
You don't top tick your NAV. It's a fucking illusion.
Right. No, you never. No, you can't, especially with gold. Like the tax rates are confiscatory. The same thing with Bitcoin. You can't make any money, trading in such a way that you just can't do it. The best thing to do is just wait for them to make a mistake and force the price down, or force themselves into a liquidation situation where they have to liquidate to get their gold positions, to get dollars, because so many people use gold as a piggy bank to hedge their dollar risk. And so when that dollar risk, hits them, they exit their long positions, get the money, get the cash they need to cover their other position, and then Bob's your uncle. That's your opportunity to accumulate.
Mm-hmm.
And you wait for those moments
of the mechanical occurrence that you just articulated beautifully.
There's nothing emotional about it.
Right. That's not a narrative. That's a mechanical sequence that is inevitable to occur a couple times a year. Right.
Yep.
It may be 4%. It might be 18%. Either way, when you see it start to happen, you get your fiat ready to convert to assets, because that's the whole damn game anyways.
Yep.
Right. And how I risk spread this is understanding that, all right, GLD et al. Is going to paper over. So I'm not buying gold to make, I'm buying gold to preserve. Right. Mm-hmm. Same thing with Bitcoin personally. Mm-hmm. And then if you want to know where Bitcoin's going, look at the monstrous bids in the order book globally. There is nothing bid like Bitcoin on earth, ladies and gentlemen. So every dip you see, you ought to buy, and you're a fool if you don't. And I don't care what kind of fallback. It's just been proven.
No, I agree with you, Chris.
It's like this. It makes in stocks, you can't even get 2 standard deviations away from bid ask. There's no one that wants stocks.
Right.
Notwithstanding the S&P itself, which will pick on why I don't personally use that to accumulate an equity position. It's because it's a mother effing tracking index that creates and redeems shares on a discretionary basis all day long.
Right.
And then if you watch futures with the S&P price and see the deviations daily, the tail wags the dog every single time. Oh, and why is that, Chris? Well, when the stock market's been open from 9:30 to 4, when all the shills and plebes can trade, the stock market's actually down. All of the actual movement has occurred in the futures market. Well, and who can access the futures market, Tom? Oh, gee, I wonder.
It's no different. You're describing the same problem that we saw in the last gold bull market from 2002 to 2011. That if you bought the New York Open and sold the New York Close, you lost 70% of your money over one of the most historical bull runs in history. Why? Because that's the way the market traded. So you don't. So again, I've trotted that one out a million times, but you can do you can see it everywhere. It's funny. What I can see right now is that it's happening in the gold market, as a matter of fact, and I'm absolutely seeing it on the European Open now. What I'm seeing now on the European Open in gold is that the price gets pushed, and it gets pushed back up during the New York market. There's been a fundamental shift in the way gold trades in New York, or in during New York trading hours. And one of these days, the silver gold ratio trade is going to blow up. That Vince Solanchi talks about all the time, is going to blow up in their face in such a way that everybody long suffering silver, bulls are going to be shocked at what happens when that blows up. Now, will it be allowed to blow up all at once? No, it's going to blow up in pieces and in stages. But when it does, it's going to be epic to watch. And it's also and we're going to see parts of that happen in gold as well.
Tom, ask me if I'm going to sell into that. I have a ton of silver.
Are you going to sell into that, Chris?
No, I'm not. Why?
Why, Chris?
You just made more money. I don't need more money. I need more assets.
Bingo.
I already bought the silver. I think I bought a lot of it at 14, 15 that I've accumulated over the last 15 years.
Sure.
I don't give a shit. And if it goes to 10, great.
I know. Like, oh, really? When silver hit the mid-teens. So I haven't bought silver in a long time because I bought most of my silver when it was $4.
Mm-hmm.
Okay, that's how long ago I bought silver, and I accumulated most of the silver I wanted because it was cheap relative to gold and relative to my income stream at the time, which is I was a middle class guy working as a chemist 2 over in the chemist 4 over at the University of Florida, making $35,000 a year. Could afford gold even at $400 an ounce. I bought silver at $4 an ounce. Now back then the 400 100 to 1 silver to gold ratio was the right play. At today, 85 to 1, you buy both equally. When it goes to 110, you buy silver. When it goes to 60, you buy gold over silver. Use the gold to silver ratio to your advantage in that respect. So I could give a shit. The last time I bought silver was $16. Like, don't make me buy more silver. I can't lift the duffel bag now. It's too heavy. Like, it is my bug out bag. Like, I can't do this shit anymore. All right, I'll buy 20 ounces and I'll walk away. But, I buy gold on every pullback. I buy Bitcoin. I have a standard allocation every month that I buy a certain amount of Bitcoin, dollar amount of Bitcoin every month. Right. I don't look at the price. I just every month. But then every once in a while, when there's a big pullback, when the government of Germany dumps 100,000 Bitcoins on the market and moves the price $10,000, I'm like, ooh, thank you very much. Yeah. Blue light special on aisle 4 in Bitcoin. I'll take some more, please. Thank you very much.
And do you think? Let me come at it the other way. And full disclosure, bought then. That was awesome. Bought today because I keep ratcheting. When I first started buying Bitcoin in 2013, it was like every time there was a 30% pullback, I'd buy. Mm-hmm. Then in 2020, it kind of got to 20. Now I'm like at 10 because I'm just so terrified. I'll give you a quick aside. We're at a soccer game. Mm-hmm. My daughter's playing, 8-year-old. I was wearing a Bitcoin shirt and some anarchist hat. And one of the parents comes over. My daughter's standing next to me, and she's like, "Don't you think you have enough Bitcoin now?" And I turned to my daughter and I said, "Mila, do we have enough Bitcoin?" She looks up. She goes, "No, we always need more Bitcoin." My 8-year-old. So that's a nice, fun story. This was not this past Sunday, but the Sunday before. Today, 10-point pullback off high. I bought. So I've gone from 30 to 20 to 10, and I just, there's only 21 million, right?
Well, and more importantly, you can see it in the chart that that dips are being bought more aggressively at higher prices. So there's absolutely Bitcoin's setting up for a massive rally towards above 70 once it closes on a monthly basis above like 68 or so. I'll look at the chart tomorrow.
68, all these shorts get blasted, Tom, and it's not you have the big boys who can just get lines of reverse repo money to cover their shorts, right? These shorts that are in physical Bitcoin short, they're just going to get annihilated. And I'm telling you, the cascade up through the order book that would create. I have posts 5-6 standard deviations up because that's the projection. I don't even want to give a dollar price because the dollar price doesn't really matter. But you could see high 80s. Low 120s before you even could blink, if that starts to occur.
Mm-hmm. I would not be surprised about that at all.
And the same thing in silver. I'm professionally doing this. I don't want that to happen.
Right.
I don't want that to happen. There's not enough investors with 15% of their portfolio in Bitcoin and Class A investment grade digital assets to have that run away from them.
Right.
They've already missed 0 to 70K, and then you're going to miss 70K to 500K. And did you see Saylor's math to 14 million?
Mm-hmm.
I can't even break it, dude.
Yeah.
It seems completely asinine, but so does $2,600 gold to someone who thought it was 35. Right.
Right. Well, dare I publicly agree with Peter Schiff, but he said if gold can go to 2,600, it can go to 26,000 now.
Full on.
I don't think gold will ever get there for a variety of reasons, which I talk about in other podcasts. And I don't want to diverge into that now. I think we should get close to wrapping this one up. But I can tell you that, we're going to be looking at multiples on both of these assets over the course of the next few years. And I don't know what those numbers are going to look like. And I don't really care because, again, it's about accumulating assets as you can and dealing with your currency risk in such a way that it offsets your liabilities and that you need to deal with on a daily basis. They're confiscating half to two-thirds of your labor through tax, through confiscatory taxation. Everything else you have left over isn't very much, and they think you don't deserve that either. So you save what you can, and then understand that as long as you keep putting that away at some point, and you keep your actual dollar risk, your dollar carry risks at a minimum, you're going to be able to accumulate more of those. I think that's ultimately, at the end of the day, that's how you define risk in the best way imaginable. You have your hard assets that are offsetting any of your other currency risk, and then you just look up and you go, cool, I have hard assets. I don't have these other risks. I'm good to go, and I don't care, and I don't need to liquidate my property. And that's the way you should consider. This way you should balance everything out. And beyond that, when you take on any kind of financial risk in the form of currency risk, in the form of debt, it should be with your eyes fully open, with the intention of getting rid of that as quickly as possible, or having enough offset in the other side of your balance sheet that
makes you not a forced seller, regardless.
Right. It makes you not a forced seller. Thank you. That's where I want to be.
And I actually think that's a good place to round the conversation off, because the whole point, I think, of the dialogue that you and I can riff with one another, that we can benefit others, is draft something for yourself, on paper or not, that's going to arrive at peace of mind. Part of that is do not ever become a forced seller, whether you're real estate, whether you're trading. And part of that rule is don't match your assets liabilities. Part of it is don't use leverage when you are speculating. There's just very, very simple, easy things to do. Yeah. And then, what I'd like to leave your wonderful listeners with is, the world's fucked up. Be stoked. You know why? Yeah. You're going to get a plethora of opportunities in various asset classes over the next 6 to 18 months that an astute, sharp investor is going to do well on. And be excited that you have the privilege to do that, because our forefathers did not have that. And as bad as shit is with Comrade Kamala and all the buffoonery in Europe and all the chicanery in China, we still got food in the shelves. We still have accounts functioning. Markets are still trading 24/7. And that is a miracle, in my opinion.
It is. And I think we should leave it there, because, and then I'm going to pray that the miracle workers that work for the electrical company get my power back on, and then I will buy those guys multiple beers, and we'll just leave it with that. We were at the Tractor Supply the other day. They were out on Sunday. They were without power. They had a generator out front. They were in a worse situation than we were, and yet they were open. And they actually turned to us and said, well, thank you for your patience and bearing with us. We're like, no, dude, thank you for actually being here, showing up under these circumstances in the freaking dark so that we can pick up a flea collar for my dog. Like, thank you.
This is why I live in the South, Tom. I love the South.
Of course. I do too. I do. All right, Chris, with that, I think we're out. So thank you, my friend. We'll talk again soon.
Appreciate you, buddy. That was fun.
Well, that'll about wrap it up for episode 195 of the Gold, Goats, and Guns podcast. I want to thank Chris Sullivan for a lively discussion. I think it was really a lot of fun, and always enjoy talking to Chris, to be honest with you. So with that said, you can find my work over at my blog over at tomluongo.me or goldgoatsandguns.com. You can follow me on Twitter at TFL1728, and you can sign up for the Patreon at patreon.com/goldgoatsandguns, where you can get the twice weekly market reports and or the Gold, Goats, and Guns investment newsletter, where we tie all of this stuff up, take a deep look into the future, and wrap it all up into a portfolio strategy that'll help you make some money while you're watching World War III unfold. It's the best I got, folks. There we go. So with that said, you guys be well. You take care, and we'll talk soon. Keep your sick on the ice.